Complete loss of capital in a decade is the topic for the discussion today. So here is a case study. A stock that was at 8500 rupees in 2008, then it collapsed to 20 rupees in 2008 crisis. Then it gradually over the next 5 years recovered back to 85 rupees, and it stayed there for next few years at 85 rupees. And then you know it could have gone here or it could have gone there. No way to know. Uh, but this is the case of Vodafone Idea, and a complete loss of capital in a decade for Vodafone lovers. This was my tweet. And at some point of time, we need to make some decisions. So this was that point that I was showing you in the previous chart right here. And up till here, I mean, just imagine yourself, and don't take this case as being critical of just Vodafone Idea. I'm saying let this be a test case where you consider this stock to be any other stock, and assume that you are like any other investor and you are sitting with a stock here where it did what it had to do in terms of a downtrend, and it recovered, and you've been here 6-7 years. Your capital is at least not eroded. You've lost opportunity cost so far, that's okay. But then now what are you going to do with the next sort of move? So you are here and the stock starts to do this, and then does this. At some point of time, some decision will need to be made, right? That you're losing capital, and you lost 93% even after waiting 6 years. You lost 93% after that also. So just waiting did not get you your desired result. For instance, last 1 year also, and it did move up since COVID. The markets have been moving up. Every donkey stock has been going up. So last 1 year again 45% drop. So maybe if you were stuck in this, maybe this was a time to get out if you have not gotten out during this period. So the idea, not the idea, the thought process should be that there needs to be an exit plan. There needs to be an overall plan. Endless waiting does not get you the result, at least not always. And all this wait is basically also giving you enormous pain. I mean, enormous stress. You are looking at others portfolios which are running away. You are stuck with a stock which is 93% down. What is the point? I mean, are you in the market to prove that you bought something at X price, so it has to be X plus this when you get out? No, you have nothing to prove to the market, and the market has nothing to prove to you. It is your own ego that I will not book this loss because I look like a fool. Well, the market has already made a fool of you. The fact is that you just don't want to accept it. People say, if I sell this stock, then I will book a loss. Well, my dear friend, you are already in loss. Booking it or non-booking it makes no difference at all. So think about things with clarity. Just sticking to some stock because your price was here, market doesn't care about your price. Market says you may have bought at 100, you are a fool. I will reward somebody who's bought it at 3 rupees, perhaps. So let your personal ego get out of this. Let's see what this journey was. So it listed at 50 rupees, March 07. It had a fantastic gain, went to nearly 100 rupees, 90% gain in 6 months. So all was going good. You were, finding great momentum here also. But then it collapsed 78% during GFG fall. If you had some proper planning, you would have gotten out somewhere here. Probably never looked at the stock again, or probably would have gotten it at 60 rupees again somewhere. Then it went to 120. So in this entire period, it was not doing anything exceptional other than other stocks. Many stocks did this at that point of time. So you may have felt that this is like any other stock, and hence what can go wrong. But uh, you know a lot of waiting, and once this lot of waiting, 6-7 years of waiting has happened, and now you are above the price, then you probably are hopeful for the next 6-7 years at least. So you are sitting here, long consolidation, expecting at least now it will move, and it disappoints, right? So you are sitting here and you are expecting to go up here, and it starts to disappoint. You have to get out there. You have made a commitment to yourself that okay, I'm waiting 6 years, but if it doesn't perform by certain time, by certain price, or by certain fundamental thesis, if you are following certain profits, certain market share, at some point of time you have to draw a line. Even Lakshman drew that line. Sitaji, don't go beyond this. You learn something from our scriptures at least. Stock was down 98% in the next 4 years, causing excessive damage and tremendous loss of capital. And Today everybody can say, okay, I was not this person, but there were millions of people who bought here also. Okay, if you entered the market at in 2021, you can say, I would not have been a fool to buy idea in 2015 at 100 rupees. But there will be enough examples right now also, what this example is showing, you would have done the same thing, and you would still be sitting waiting for that move to happen. And I'm not saying idea will never perform. Maybe it will, but right now it is not doing that. And right now it is causing a lot of heartache. Probably many heart attacks have already happened because of this stock for many investors. Comparing Airtel and Nifty with Vodafone. Okay, so now I'm saying don't even look at absolute performance of this stock. Maybe we should have seen what it was doing versus the industry, versus the overall market. So you are seeing it's a consistent underperformer. Airtel was going up, Nifty was going up, this is going down. Why you want to stay with any stock that is going down? There is absolutely no logical reason, at least. In your mind, you can cook up a lot of stories, that first it will go down, operators will take it down, then you are going to buy it and operators are going to buy it, and then it will go up like a rocket. These are like concocted stories in very disturbed minds, that there is a conspiracy happening in the market, and I am part of that conspiracy, and I am with the stronger hands which are taking this down purposefully. Get out of all this nonsense thinking, perhaps. So strong exit rules are critical for long-term success in investing, no doubt about it. You can use the simplest of tools. 20% drop from the top, I want to at least reconsider my decision. 30% drop from the top, I want to at least get out of half my position. 40% drop from the top, it's going to really take me some reason to stay in this stock anymore. 50% drop from the top, I am going to cut out. Whatever happens. I'll buy it again if it starts to go. These are rules. I'm not saying adhere to these specific rules. I'm just saying that these are rules that you can make. You could make some other rules. You could just say 200-day moving average breaks down, I'm getting out of it. Whatever be your rules, you have to stick to the rule. Just imagine you are a soldier and you are on the war front, and your battalion chief has told you, if this happens, you have to do this. At that point, if you start to think, no, maybe I should go here, maybe I should go from there, maybe I'll use this bullet, or then you are going to get killed. And that's exactly what happens in the market also. So biggest challenge plaguing the investors is waiting. Just this indecision to wait and hope that something will happen. So in India, I mean, we are all very religious people. We have seen 60 crore people go to Mahakumbh in the hope that something good will happen in our lives, and the belief is very strong. But please don't bring that into the markets. Markets are like a business. It doesn't work on hope. Yes, the gods will bless you, but you will need to do something positive and something right for the gods to bless you. If you will be a donkey investor, gods are also watching who to bless, in my view. So don't just wait, because waiting will not going to do anything. So psychology of holding on weak stocks, hope over reality. So investors assume that stock that has fallen sharply will eventually recover. There are millions of stocks globally where stock falls, never recovers. Millions of stocks. Go and see the chart of Citibank. It dropped in 2008 like a rock. It never recovered. So the fact that a stock drops and it has to recover, that is only in your mind. It is not, you cannot prove it statistically. Investors ignore the fact that weak stock tends to remain weak. So the propensity of a stock that is weak is to stay weak until something changes, and downtrends will often persist. Downtrending stocks will rarely lead future rallies. That is also a fact. If in the last 4 months the stocks that have hurt the most are unlikely to lead the next rally, a new set of stocks are going to lead the next rally, likely the ones which have not fallen the most. So leadership will change, strength will rotate. Investors will feel loyalty to stocks that they've held for a long time. So please don't marry stocks. Keep the marriage in the house only. With stocks, be very ruthless. Divorce your stocks if you have to, immediately, as and when required, as many number of times required. Don't bring your moral ethics into this stock business. In our mind, we develop a story around the stock. We believe it deserves to rise again. So there are two deserving things that happen in our mind, that the stock deserves to rise because I think XYZ is right in the company. And to my price, I bought it at 100, it is now 10 rupees, so it has to come back to 100 rupees because I bought it there. I deserve to see that price again. That is also lunacy, actually. So, price is the only truth. Sticking to old leaders that have lost momentum can be disastrous, and it is disastrous for a lot of folks. Now, the sunk cost fallacy, that I have already lost 60%. My stock was 100 rupees, now I'm 40 rupees. So, I've already lost 60%. अब इसमें क्या चला जाएगा और? But 40 rupees stock can also go to 4 rupees. So, you can lose 90% more of your investment now. So there is no point at any point where you can say the stock going further is not going to hurt me. The stock can hurt you even at 1 rupees. It can go to 5 paisa. At 5 paisa, it can go to 1 paisa. At 1 paisa, it can stop trading. So at every point you can get hurt. You have to realize that. Focus remains on recovering past losses rather than maximizing future gains. So this clouding of our mind that, I lost 2 lakh rupees, so I have to recover that. You have completely forgotten about your whole purpose, that you had deployed 10-20 lakhs and you were going to make 20 lakhs on that in the next 5 years. So that focus is completely gone from your mind, and right now the only focus is, I've lost 2 lakhs on my 20 lakhs, let me somehow make this 2 lakhs back quickly and do whatever that is needed to do that, to get there. So that is a very big problem, and it causes revenge trading, revenge investing. Let me quickly get into some leverage. Let me quickly, buy some, get some hot tips to make up this capital, not realizing that losing of that capital was part of a longer term journey. And just like you were losing some time, you are also going to gain some time, but your thesis has to remain intact. So the goal is to allocate capital where strength exists, not where recovery is hoped for. Anchoring bias, as I already mentioned, people get fixated on their purchase price and they wait for stock to rise to that level, even if stock is not willing to go there. So I bought idea at 50 rupees, now I'm fixated there. I 50 से कम तो बेचूंगा ही नहीं मैं. So, that is becomes like a reference point in your mind. Everything less than that is like, market is undervaluing my stock. It should be above 50 rupees. So, but market is real. I mean, price is telling you what it is worth today. If it is 5 rupees, you want to see it 50 rupees, okay, you give it to your grandchildren. Maybe they will see it 50 rupees at that point. So anchoring to past prices is meaningless. Instead, it may be better to focus on recent momentum. And then we also look at confirmation bias. So for investors seeking news or opinions that support holding the stock. Okay, I am using, Idea, Vodafone, line is very clear. I'm able to see hoardings everywhere. They are coming out with new ads. So you confirm to yourself itself that yes, this company is doing great. The stock is telling you, please get out. You are saying, no, no, this company is great because I can see it all around me. Well, that's the ploy. They want you to see the company all around you, and this is not just against idea, by the way. So, celebrating minor rallies with long-term downtrends, ignoring the larger momentum structure. This is another problem. Now, stock is coming down, and the larger trend is down. But there are minor rallies. When those minor rallies are happening, you're telling yourself, see, I told you there is, going to be an upward trend in this stock. And that rally lasts for 3 days, just like Nifty is happening right now. All the bulls are celebrating the 3 days of rally that we get, and then we get smashed down again. So this is the confirmation bias that we all have for the Nifty or for the stocks or sector that we do. So true trend reversal has to be happening. Higher highs, higher lows has to be created. New strength has to come. New liquidity has to come into the market to really take it up. Otherwise, confirmation bias, we can just sit around and like what is happening around us in favor of the instrument that we have. So if some minister will come and say, okay, GDP next year will go so much, we are all cheering, yes, very good, because we are all holding Nifty or some stocks like that. But that isn't going to do anything for us. The fact is that the market has to take off, because liquidity has to come in, and liquidity will come in when there is expectation of something good happening. So all that is linked. So strong stocks will stay strong, weak stocks will stay weak, and hoping for turnaround is not a strategy. Have a strategy where hope is not a part of the internals of that strategy. Yes, you getting lucky is something external. You are following a strategy, and then you get lucky. You came to the market, and within the first 2 years you got what you would have expected in the first 7 years, for instance. That is luck. But luck didn't help you plan your strategy. Luck may help you otherwise. You may be sticking to the strategy, that may be lucky. Or your timing into the market, that may be lucky. So just not having strategy and then hoping that some luck will strike you gold is likely not going to happen. So exiting, key takeaways are: exiting bad investments early. That is number one. Crucial to protect capital and reinvest in stronger opportunities always. Follow price, not emotions. Ignore news, opinions, and emotional attachments. Bhava Bhagwan che, BBC principle. That is the only savior in this market. Set exit rules, have predefined stop loss or trailing exits to remove emotions from decision making. Stick with strength. इसको गांठ बांध लो आप. Stick with strength. वीकनेस के साथ नहीं रहना है. Shift capital to stronger high momentum stocks instead of waiting for recovery. Cutting losers early is what keeps you in the game. Please see this again and again. If you need to have this drilled into your system, practice this. It will take maybe one or two business cycles for you to get this. Even if you get it in 10 years, your next 30 years are going to be amazing. Let me know in the comments how you like this content. Do like and share these videos. Your one share to the right person, which changes his or her life, can be that golden share that you could do. My request is, please do share with everybody who you think can make use of such videos. Thank you so much, and I'll see you in the next one. Bye.